Hey everyone, it's Mrs. De La Rosa. I just wanted to do a quick little lecture on Chapter 2, Analyzing Transactions, the Accounting Equation. This is a smaller version of the PowerPoint that I uploaded today, but I thought it might be helpful if I went over just some of the problems in the PowerPoint. All right, so as we are going through the homework problems and the assessment problems, I want you guys to keep these three questions close by. We're talking about analyzing business transactions here, so it's important to ask yourself three questions. We first need to understand what happened, make sure that you understand the event that took place, and then you need to understand which accounts are affected. We need to identify if it was our assets, our liabilities, or our owner's equity. And then the last question you need to ask yourself is, how is the accounting equation affected? All right, so the PowerPoint that I uploaded talks about Mitchell's campus delivery. So let's go over the transactions. Okay, so transaction A, we are looking at an investment by owner. So our example here is that Mitchell Williams invested $5,000 in his business. So when we invest money in a business, that's put into our capital. So as you can see, our capital increases by $5,000, but our business also now has an asset of cash for $5,000. And then as you can see, the amounts equal on both sides of the equation, so that's something important to keep in mind too. We have to make sure that it still balances. All right, the next thing that Mitchell does is he purchases an asset for cash. So Mitch bought delivery equipment for $2,000 cash. All right, so first and foremost, his cash is going to decrease by $2,000. So we had $5,000 minus $2,000 gives us $3,000. But we have a new asset account of delivery equipment, and that's going to increase by $2,000 here. Okay, and then when we bring down the totals, 3,000 plus 2,000 equals 5,000 on the asset side, and then over on the other side we still have the capital of 5,000. So you can see our equation still balances. All right, so the next thing we're going to look at is the purchase of an asset on account. So Mitch bought delivery equipment for $1,800 on account, okay? So we didn't touch our cash. This has now become a liability for the business, right? It's a bill that the business owes. So that goes under liabilities, and our title for that is going to be accounts payable. And you're going to see that we are increasing our liabilities by $1,800 because now Mitch has to pay that bill. You're also going to see on the asset side that our delivery equipment increases, the value increases by $1,800. So again, if we bring those totals down, 3,000 plus 3,800 gives me 6,800 on the asset side, and then over on the other side, our liability and owner's equity side, we see that our totals do add up to 6,800. In transaction D, we're going to look at a payment on a loan. So Mitch paid the first installment on the scooter of $600. Okay, so our liabilities are going to come down, right? So we don't owe $1,800 anymore. We now owe $1,200. So we are going to put in there for transaction D, 1,800, we're going to put minus 600. Now our new total of the amount that we owe for that scooter is 1,200. Okay, he pays cash to that loan, right? So now we have to say goodbye to $600 of our cash. So we minus 600, and that gives us a new total of $2,400 in cash, plus the 3,800 in delivery equipment gives me 6,200 on my asset side. And after I total up the new total for the liabilities, the bill that I owe, I have $1,200 plus the $5,000 that I've invested in the business. So that gives me $6,200 on the other side, and you can see that our equation balances. In transaction E, we're going to talk about a delivery revenues earned in cash. So Mitch received $2,100 cash from clients for delivery services. All right, so this is good news for Mitch, right? His cash increases by $2,100. So now he has $4,500 worth of cash in the business. And over on the owner's equity side, we are going to increase our revenues by $2,100. And when I total everything up again, it still balances. In transaction F, we look at paid rent for the month. So Mitch paid $1,000 for June office rent. So just like when we pay our rent, right, our cash decreases from our bank account. So here Mitch took $1,000, so we put minus $1,000 from our cash, and then we also have to put this under expenses. Remember, expenses are things like the rent, the utilities, phone bills, those are expenses. Now, our expense account increases by $1,000. And then when we add everything up, it still balances. In transaction G, we have Mitch paid $100 cash for his phone service. So anytime we pay our phone, right, we decrease our bank account, our cash, by, in this case, it's $100. All right, so my new total is $3,400. And then over here on the other side, phone service, our phone bill is an expense. So my expenses have increased by $100. So my new total is $1,100. And then when I total everything up on both sides, they still balance. All right, in transaction H, we have delivery revenues earned on account. So Mitch performed delivery services in the amount of $2,400. So my revenue over here is going to increase by $2,400. So now my total revenue is $4,500. And since these services were performed on account, I now have an asset called accounts receivable. Now be careful, accounts receivable is money that people owe us. Accounts payable is money that we owe other people or businesses. So here we are going to receive in the future $2,400 for performing these delivery services. So this accounts receivable is an asset account, and when I add everything up, you will see that it balances. In transaction I, Mitch purchased supplies for $80 cash. So the first thing I want to do is I want to subtract $80 from my cash. So now I only have $3,320. But now I also have a new asset account of supplies in the amount of $80. Okay, and when I add everything up, it balances out. In transaction J, Mitch received $1,900 in cash for delivery services performed for customers earlier this month. So the people that owed him money paid him. So as you can see, my accounts receivable here is going to decrease by $1,900. These people don't owe me $2,400 anymore, right? So they made a payment to me, so now all they owe me is $500. And then over here, my cash is going to increase by $1,900. So my new cash total is $5,220. And then when I add them up, they balance out. Okay, so in transaction K, we purchase an asset on account and we make a partial payment. So Mitch bought a scooter for $1,000. He paid $300 cash, like a down payment, and he agreed to pay the rest over 4 months. Okay, so I know that I paid $300 cash, so I'm going to subtract $300 from my cash, and now all I have is $4,920. And then I see that the liabilities, I now owe this company $700, right? So I bought the scooter for $1,000, I gave them $300, so I owe them $700. So my accounts payable, the money that I owe people, increases by $700. So now I owe $1,900, okay? And then my delivery equipment, that asset is going to increase by $1,000. So now I have delivery equipment totaling $4,800. In this transaction, we pay an insurance premium. So Mitch paid $700 for an insurance policy that lasts 7 months. In week 3, we will talk about depreciation. So there will be some division, but for right now, we're just entering the transaction, okay? So my asset of cash is going to decrease by $700, right? Because I paid for an insurance policy. So now I have $4,220 of cash. But prepaid insurance is seen as an asset to the company. So that account increases by $700. And then, like I've been saying, as we add them all up, they should balance out. In transaction M, we have a payment of wages. So Mitch pays $1,650 in wages to his employees. Got to pay those people, right? So first and foremost, I know that I am taking $1,650 out of my cash to pay them, right? So now I have $2,570 in cash. And then over here on the owner's equity side, my expense of wages increases by $1,650. So my expenses now total $2,750. In transaction N, we have deliveries of $3,500 were made, $900 was in cash, and $2,600 is on account. Okay, so my cash increases by $900 right here. So I now have $3,470. And then my accounts receivable increases by $2,600. Okay, so people owe me $2,600 in the future. That's an asset over here. So now the amount that people owe me totals $3,100. On the other side of the equation, we recognize the entire amount of the revenue as it is earned. So here it was $3,500. So I'm going to put all of that as an increase in revenue. And so now I have $8,000 of revenue. Okay, last transaction here, transaction O. We have a withdrawal of cash from the business. So Mitch took out $3,000 out of the business for personal expenses. Okay, so the money we put in the business is capital. The money that we take out for personal use is drawing. Okay, so my drawing account increases by $3,000 here, and then my asset of cash is going to decrease by $3,000. So now my business only has $470. And when I total everything up, they balance out. Okay, some of your homework problems have income statement, statement of owner's equity, and a balance sheet. So let's go over those very briefly. So our income statement, the way we fill these in is that we take our revenues. In this case, it was the delivery fees that he charged everybody, okay? So remember that was $8,000. So we put that number there, and then I find all my expenses. So he paid people, he paid rent, and he paid his phone, right? So we put those totals right here, and then we total up these expenses, and we put that over here on this side. It says total expenses, put it in there. So then to figure out if I had a net loss or a net profit, right, I have to take my revenues minus my expenses, and that'll give me my net income. All right, looking at the statement of owner's equity here, our Mitchell Williams' capital as of June 1st was 0. During the month of June, he did invest $5,000, so we put that number over here. His net income for the month was $5,250. Remember, that was our revenues minus our expenses from the previous slide. We take that number and plug it in here. And then we have our withdrawals for the month. Remember, he took out $3,000 for personal use. Okay, that number goes here. All right, so my income minus my withdrawals gives me my increase in capital of $2,250. Okay, and then when I add the investment plus my increase in capital, I get my final capital amount. And here it says June 30th. And for this example, we have $7,250. Okay, last slide here. We're going to talk about the balance sheet. So this is Mitchell's campus delivery balance sheet ending June 30th. So he put all of his assets over here on this side. So we had cash, accounts receivable, the money that people owe us, the supplies he bought, the prepaid insurance, and the delivery equipment. That totals up to $9,150. So remember, assets equals liabilities plus owner's equity. That's our equation, right? So the liabilities he ended up with, his accounts payable, the final total there was $1,900 for the month. His owner's equity was $7,250. And so when I add the liabilities plus the owner's equity, I get $9,150. Again, so it balances out. So as you work through your homework and the assessment, please use the check your work button. That's going to be really helpful so that if you've made an error early on in maybe plugging in the transactions and you get to the last line where we balance out the equation and it doesn't balance, that's going to be a great place to fix any of those errors before you move on and create any of these three statements. So I hope this helps. Let me know.